Good afternoon, everyone, and thanks for joining us for today's webinar, 2025 State and Local Tax Update. I'm Lindsey Haney, Director at McKonly Asbury and leader of our firm's State and Local Tax Group. If you're not familiar with us, McKonly Asbury is an accounting and business advisory firm with offices in Camp Hill, Lancaster, Bloomsburg, and Philadelphia, Pennsylvania. We offer a wide range of services to organizations in various industries. For more information, please visit our website. If you've joined us in past webinars, welcome back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going on around us. Be sure to check out our website to catch past presentations as well as current information through our blog. Our thought leadership subscription, M&A Insights, has been revised to give our subscribers the opportunity to select which topics are most relevant to them. Subscribe today to stay informed. If you have any questions for us during today's presentation, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during the webinar. For those of you that are looking to obtain CPE credit for today's webinar, please keep in mind that there will be 5 polling questions throughout today's presentation, and you must answer all 5 of these questions to get your certificate via email within a month after the webinar. In order for attendees to be eligible, you must answer via the polling submission, and we will not accept late responses. So with that out of the way, let's get started. So today, the topics covered are these 4. We're going to start with the recent federal legislation known as the One Big Beautiful Bill, or I'm going to refer to it in this presentation as OB3. We're going to move on to a discussion about nexus, since I think that's always an important one to touch on. And then I have a little bit of a futuristic talk about technology and taxes. And then we'll round it out to talk about the PA budget and a few other state tax updates as well. So first of all, OB3 changes. 2 of the big changes that you probably heard about with the One Big Beautiful Bill were no tax on tips and no tax on overtime. So the tips deduction, it's employees and self-employed individuals can deduct up to $25,000 in qualified tips per tax return, but this does phase out at $150,000 of income. These must be reported tips, they can't be estimated, and the W-2 form was just updated for these items for 2026, I believe. And it must be in a customarily tipping industry, so restaurants or possibly hairdressers, something like that. Us accountants, unfortunately, cannot add a tip line to our invoices and consider that non-taxable. So, and then the other one is the no tax on overtime. This is a $12,500 deduction on overtime compensation, and it also has a similar income deduction to the tips one as well. It must be overtime reported under the FLSA. So for both of these items, they are what we call above the line deductions. And when I talk about above the line I'm talking about is where that arrow is right there on your screen. So it is the line below adjusted gross income. So above the line deduction means that it's a deduction that's taken into consideration when calculating adjusted gross income. It's before adjusted gross income, the adjusted gross income number is calculated. So that means above the line, and that becomes important, which I will explain on the next slide. But there also then is proposed legislation in Pennsylvania. There's 2 House bills in order to take these federal items into Pennsylvania income. There's some proposed bills to do that. So speaking of that adjusted gross income, let me move on to the next slide here. So when we talk about how state taxes are impacted by federal legislation, there are a couple of different things to consider. But the very first one is, what is your state tax starting point? So what number do you start with when you're talking about state taxes? According to this chart, as you can see, a lot of states start with federal adjusted gross income. That's the federal AGI, or the orange section there. That's 31 states. So what that means, and here, let me go back for a second. What that means is when you look at here, that adjusted gross income line, that is the state starting point. So for above the line deductions, these would be included. But if they were below the line deductions, they would not be included for a state that starts with adjusted gross income. So again, back to the chart, you can see 31 states start with that federal adjusted gross income, but then there's a couple of states that start with federal taxable income. So the federal taxable income, that is, and we'll go to the next slide in a second, but that's after adjusted gross income. So you calculate your adjusted gross income, and then you have some additional deductions, and then that calculates taxable income. So when we say below the line deductions, they're used in calculating taxable income, but not adjusted gross income. So you have a couple states that follow taxable income, and then the blue there, you have a few states that use their own calculation. So they don't have to follow the federal numbers at all. They can calculate income their own way. All right, so with that, we move on to our first polling question, and it's a little bit of a quiz here, but I'll test you a little bit here. What is Pennsylvania's starting point for individual income tax? Is it federal adjusted gross income, federal taxable income, neither, a state-specific amount, or if you're just here for the CPE credit and not in the mood to answer my quiz question, then go for it. So I'll give you a few seconds here. Make sure you're answering that polling question if you want the CPE credit. All right, make sure you get in your answers to that poll. I'll give it just a few more seconds here. We want to make sure everybody gets CPE credit. All right, moving right along. All right, it's fairly evenly split, but it looks like we did get that question right overall. So the answer is neither. Pennsylvania uses a state-specific calculation for AGI for the individual income taxes. So there was a little bit of a hint there when I said on the tips deduction and the overtime, I had mentioned that Pennsylvania has House bills that are proposed in order to enact those changes. That's because Pennsylvania doesn't follow federal, because if Pennsylvania followed federal AGI or federal taxable income, they would automatically follow those deductions. But because they don't, they have their own state-specific calculation, then they have to put legislation into place in order to follow them. All right. What are some other changes? Now, keep in mind, I'm not going over every single change in OB3. That would be a whole webinar in itself. So I'm going to touch on a couple, and really I'm just trying to get you to understand how state taxes are affected by that federal legislation. So another thing that I wanted to mention, the increased standard deduction. Keep in mind, increase is a very relative term. It depends what you're comparing it to. You've probably heard a lot of different numbers and comparisons from Republicans and Democrats on how proposed legislation compares. And the question is, what does that compare to? Because if you compare the standard deduction to what it was in 2024, the OB3 didn't really have any major changes. It really just extended things. But a lot of times you'll hear that it's almost doubled or it's doubled. That's because they're comparing it to what would have happened had nothing been passed, because it was set to expire and go back to the previous levels of the standard deduction. So there is an increased standard deduction. It's kind of just a continuation of what was happening before. With the standard deduction and itemized deduction, just to kind of set our baseline knowledge here, on your personal tax return, you generally either take a standard deduction or you itemize your deduction. Itemized deductions include things like mortgage interest, charitable contributions, and state and local taxes. And you would have to have enough itemized contributions of those types of items to be more than the standard deduction, because otherwise it would just make sense to take the standard deduction. So that is increased. There's also an additional $6,000 senior deduction. Now this is for those over 65 years old. So each person gets $6,000 if they're over 65 years old. And that can be taken in addition to either the standard or itemized deductions. It was essentially meant to be, if you heard no tax on Medicare, this is kind of what that's representing, although it really doesn't have anything to do with Medicare. It's just a flat $6,000 deduction. It does start to phase out for those with over $150,000 of income, and it does expire after 2028. So it's only temporary, not really connected to Medicare at all, but it's kind of intended for those over 65 to sort of reduce their tax burden. So with these itemized deductions, if you look at that chart below, you can see on line 12 that this is where the standard or itemized deductions get deducted. So that is after line 11, which is their AGI. So this is below the line, meaning for states that follow adjusted gross income, these changes would not have any effect on them naturally. They'd have to put some sort of legislation in place if they wanted to follow something like this. Whereas states that follow taxable income and start with federal taxable income as their starting point, they would automatically follow these changes, or they'd have to put legislation out there in order not to follow them. So we have the mortgage interest limitation. That essentially stays the same. It was a limitation put in with the Tax Cuts and Jobs Act to essentially just limit the amount of mortgage interest you're allowed to deduct for homes over $750,000 when they're bought. So if you have $1 million home, then you're going to be limited in the amount of mortgage interest you're allowed to deduct. You must itemize for that deduction to make any sense or to actually give you any benefit. And then it's the same thing with the next one, which is the car loan interest. There is a provision to deduct car loan interest as an itemized deduction on Schedule A, and it has to be a car that has final assembly done in the United States. You have to have enough itemized deductions, though, to get a benefit from this. So basically, your overall itemized deductions have to be higher than the standard in order to actually receive any benefit from this. You can take up to $10,000, and it's effective for 2025 through 2028 on certain vehicles. So there's a lot of rules. Again, I'm not getting into the specific federal rules, but that car loan interest is an itemized deduction, so it would be on line 12 there. It would be taken into account for states that follow federal taxable income. Then there's a few honorable mentions I'll say as well. Charitable donations, they've extended and made permanent, I believe, the $1,000 per person deduction that can be taken in addition to the standard deduction. So before, charitable contributions were just an itemized deduction and there wasn't really a limit. Now there's actually a floor on that, so you have to have a certain number of contributions for any of them to be deductible based on your income. Again, it gets a little complicated. I'm not spending the time today, but you're able to deduct charitable donations even if you have a standard deduction. So that's something that wasn't in place last year. We've had it in the past, but it was being kind of on and off, and now it's more permanent. The other honorable mention I have is gambling losses. So they're even more limited than they were before, just another thing to know. The qualified business income deduction, this is a 20% deduction that was put in place for pass-through entities to put them on more even ground when the corporate rate was cut to 21%. So it gave pass-throughs a deduction so that they're paying less tax so that not everybody switched to a corporation when the rate lowered. It was set to expire after 2025, but now it has been made permanent. The limitations are adjusted as well. There's a few changes, like there's a minimum deduction in place. But the line item there, you can see that is actually on line 13 in our calculation there below. So that is a below the line deduction, would only affect states that follow taxable income, not states that follow AGI. And then finally, we move on to some credit. So just to give a little more background, the difference between a deduction and a credit is quite important because a deduction lowers your taxable income. So it's in this calculation that's pictured. A credit lowers your tax. So you would calculate the tax based on your taxable income, and then a credit lowers that amount. So there's a difference between a deduction and a credit. The child tax credit increased from $2,000 to $2,200 in 2025, and it is indexed for inflation. It would have, without any change, it would have reverted back to $1,000 in 2026. So that has been increased. There also are some additional rules, like there has to be a Social Security number for the child and the parent. And then the child independent care credit went from 35 to 50% of expenses for certain individuals. It depends on your income. So for a lot of people, the child independent care credit might remain unchanged based on their income limits. It's really just dependent on how much income you have, but lower income families can benefit more by deducting more of the expenses. And that credit is based on the expenses that you have for childcare. So if you pay for your child to go to daycare or something like that, that would go into the credit calculation. Now these credits, because they are calculated after the federal tax is calculated, states typically don't follow credits. They put their own credits in place. States typically don't follow the federal ones. However, they can, such as the child independent care tax credit. Pennsylvania actually does have its own child independent care tax credit, and it follows the federal amount. So presumably the Pennsylvania child independent care credit is automatically increased because the federal one increased. So that can be affected like that as well. That's not, through the starting point or anything like that. That's just the fact that Pennsylvania put that credit into place previously and linked it to that federal credit amount. All right, then, and then I have a chart here just on conformity to the Internal Revenue Code. So you can see it's kind of a mixed bag here. Now we talked about whether state follows federal adjusted gross income or federal taxable income. This is actually something a little bit different. This chart is showing which internal revenue code the state is following or not following. And what I mean by that is if a state follows federal AGI, it could actually follow one of two things. It could either follow the federal AGI as it currently is, the current law, and that would be rolling conformity. So when new federal legislation comes out, states with rolling conformity automatically follow that legislation, versus some states have fixed conformity. And fixed conformity means that the state follows the Internal Revenue Code as of a specific date. So they might follow it as of 12/31/21. So for those states, when there is federal changes, they don't automatically follow those changes. They have to actually pass their own legislation to say, we do want to update and follow the federal changes. We're going to update our conformity date. So of those 31 states that we saw that were following federal adjusted gross income, it's split about half and half. And you can see from the chart here too, like it's about half and half whether or not the state follows current rolling or fixed conformity. Pennsylvania, you can see kind of stripes there. That's because they have different rules for individuals and corporations. So we answered the individual question is that, individually they don't follow federal at all, but for corps they do. So that's why it's kind of mixed there. All right, bonus depreciation. So in case you're unfamiliar, bonus depreciation is where you're able to deduct an asset, when you have 100% bonus, I should say, you're able to deduct the full cost of a business asset in the first year. So normally when you purchase an asset, the tax rules require you to depreciate it over its useful life. Bonus depreciation allows you to just depreciate more of it in the first year. So that was 100% in 2022, and then it has been phasing down. So it's 80%, 60%, 40%. You can see there, it actually would phase down to 0 by 2027. With OB3, that has been made permanent. So actually since January 19th of this year, so this is retroactive. So as of January 19th, any assets you acquired that qualify for bonus depreciation can take 100% bonus depreciation. So that's a big benefit for businesses. It makes things a lot more predictable. You don't have to play around with the timing quite so much. Like when the bonus depreciation percentage was lowering, there was a big question of, do you want to buy something in December or do you want to buy it in January? Because there's a big difference in the deduction you're allowed to take. It is a temporary difference though, because you would still depreciate the asset over its useful life if you weren't taking bonus, but it really helps businesses be more motivated to purchase more business assets when they know that they'll be able to deduct the full amount. The R&D, the domestic research and development expensing, for the last several years, that had to be capitalized and amortized over 5 years. Now that's gone away and it can also be immediately expensed. And then one I didn't include on the slide here that's pretty important is qualified production property. So there's actually a provision as well for real property. So real property being like bigger assets, like buildings, things like that, which normally is not eligible for bonus, is now eligible for bonus if it's used in qualified manufacturing and production activities. So that's kind of a big deal because those can be, normally with bonus assets, it's 5, 7, 15-year assets maybe can take bonus. These are assets that are normally 39 years that may now be able to expense in the first year. So that could be a big difference for a business. The state impact of these, you got to think about that. It's dependent on conformity. So not all states allow bonus depreciation. So that's something to kind of consider, especially with planning, is if a state doesn't allow bonus, does it make sense to take bonus or does it make sense to take a Section 179 deduction? A Section 179 deduction does essentially the same thing. It allows you to deduct an asset in the first year. However, there are dollar caps on 179 and some states do also limit 179. So it really just depends on the state's rules whether you should take bonus depreciation or 179. And that's something that your accountant should be reviewing and making sure you're maximizing your tax savings there. The qualified production property, I should say as well, one thing to consider is it's kind of a question whether or not states would allow bonus depreciation on that. I would say likely no, just because 39-year property is not typically property that qualifies for bonus, but I suppose it depends on how the state's rules are written, whether or not they would allow it. Pennsylvania does not allow bonus depreciation. So for Pennsylvania businesses, it may make more sense to take 179 and just forego the bonus because it does end up being the same result. and Pennsylvania allows 179. It used to be more limited, but now it's not, so 179 can be the same as federal. All right, then we have the interest expense limitation. So with TCJA, for many businesses, their interest expense is limited to 30% of an adjusted taxable income number. Before 2021, that adjusted taxable income number was based on EBITDA, earnings before interest, taxes, depreciation, and amortization. So essentially what you would do is you would take your taxable income, you would add back those items, take 30% of that, and that's how much interest expense you were allowed for the year. The additional amount would just get held, and you could potentially deduct it in the future, but it was kind of held in limbo. From 2022 to 2024, that calculation changed to be a little less favorable because you weren't allowed then to add back the depreciation and amortization. So when you can't, those are generally pretty large deductions for a lot of companies, so less interest could often be expensed when that calculation changed. So with OB3, especially because of allowing 100% bonus now, they moved it back to EBITDA. So now that depreciation and amortization can be added back, which means more interest expense will be able to be taken. So that kind of makes sense when you add in the bonus depreciation rules that this would go back to that calculation. And we really did see it start to affect a lot of our clients. We were seeing more and more clients with limited interest because it really changes the tax answer when you have to add that, when you can add that depreciation amount back or not. All right, and then finally, I wanted to talk a little bit, well, I guess a lot, about pass-through entity taxes. So this is a big deal for state taxes. I want to go over the timeline a little bit, and then we'll talk about how OB3 changed things a little bit. So back in 2017, when the Tax Cuts and Jobs Act passed, there was part of what allowed it to pass so that there wasn't too much of a revenue impact was a $10,000 limit on state and local taxes that could be deducted on an individual's return. So this is back to those itemized deductions. This is one of those. So prior to the TCJA, you could deduct the full amount of any state and local taxes that you paid, and that was an itemized deduction. So that could be a pretty big deduction for a lot of people. With the Tax Cuts and Jobs Act, that was limited to $10,000. So that was not a benefit for taxpayers. So states immediately started looking for workarounds for this because it was really detrimental to states with a higher tax rate because they were really, their residents were really being impacted by this. So they started looking for workarounds. And then in 2018, Connecticut was the first one to create a pass-through entity tax. And what that did was it moved an expense, a state tax expense that would normally be at the individual level, it moved it to the entity. So even if you have a flow through with a partnership or an S corporation, normally your income for state passes through just like your federal income, and then you pay the state tax at your individual tax return. So you report the income on your individual return and you pay the tax there. Pass-through entity taxes allow those partnerships and S corporations to file a return that says we're going to pay tax at the entity level. And the reason for doing that is because when you pay tax at the entity level, then instead of deducting it on your personal return, the entity can then deduct the state and local tax. And so the entity would have a lower federal tax bill because they're paying state tax at the entity level and are able to deduct it. So Connecticut came out with that, states started to follow suit. And then in 2020, the IRS put a notice out there that basically said that we bless this workaround, we're allowing it. And you can go ahead and continue with your PTE taxes and do it that way. And so after that came out with the IRS saying they would allow it, that made a lot of more states come out with it and have their own rules. So a lot of states have these PTE regimes. Finally, I have 7425, that's when OB3 was passed, and it increased that SALT cap from $10,000 to $40,000. That $40,000 does increase each year. But the $40,000 is for taxpayers with income under a certain amount, under $500,000. And for taxpayers with income over $600,000, their cap is still at $10,000. So it depends on your income. If you're between that 5 and 600, then your SALT limitation is somewhere between 10,000 and 40,000. But everyone's is somewhere between that limit. So as I mentioned, now $40,000, most states have a PTE regime. I'll show you a chart in a second. Pennsylvania does not. Most states do, but Pennsylvania is one of the few that still doesn't, possibly because the rate is pretty low already for individuals. And then Pennsylvania has kind of a weird provision as well. So when you pay tax in your resident state, like if you live in Pennsylvania and pay tax, they generally allow a credit for taxes that you pay to other states. So like if you have a business that's operating in multiple states, they'll tax you on all of your income, but then they'll give you a credit for the amount that you paid to other states so that you're not double taxed. Well, Pennsylvania's come out with guidance that basically says for S corporations, they'll allow you to take an out-of-state credit for those PTE taxes paid to other states. However, that same guidance says that that is not allowable for partnerships. So it's a little bit odd. I'm not quite sure why you would base the type of entity on whether or not you're allowed to deduct it or not, but that is just something to be aware of. I'm not sure it's defendable because under the Pennsylvania Constitution, it seems like you're taxing two people differently, which isn't allowed. So we'll see if there's more development on that. As I mentioned, there is a bill with like a PTE bill out there, so maybe Pennsylvania will pass its own PTE tax and that'll change things. We'll just have to wait and see. And then finally, the last point on there is asking, you have to realize what state returns you're filing. A lot of taxpayers don't even know what their accountant is filing for them. So when it comes to states, typically there's a normal partnership or S corporation tax return that's required to be filed. And that's the tax return that just reports how much income did you have. So it reports that to the state so that they know they're supposed to be collecting tax. But normally there's no tax due on those unless they require some kind of non-resident withholding. There's also, even before the Tax Cuts and Jobs Act, there were composite tax returns, and these were often optional tax returns that allowed non-residents to come in and say, hey, we don't want to have, like if my business is operating in North Carolina and I don't want to have to file there myself as an individual because that's my only income there, we're allowed to file a composite return reporting all of the non-resident owner's income and paying the tax, which often would relieve that individual of their filing obligation in North Carolina or whatever state it is. So that was just kind of a convenience thing, and the states like it because they know they're getting their tax then. Whereas the pass-through entity return is often another separate return, and again, it's to pay taxes at the entity level, not at the individual level, unlike a composite return, which is just paying tax on behalf of the partners, not at the entity level. So kind of confusing. Some states have these all as separate returns. Some states have PTE as an election on their return. So it's all like combined in one. It really just depends. And then here's that chart I promised. So you can see all the states in blue have pass-through entity tax returns. They have some kind of election that you can do to file pass-through entity taxes. Pennsylvania has some proposed, but it's one of the few that doesn't actually have it yet. And then the other thing you want to make sure you're thinking about is planning considerations. So if your income is over $600,000, you're still limited to that $10,000 cap, but even if it isn't, it's still something that you will want to consider for PTE filings. It really depends on your unique situation because it depends how much you're paying in state taxes. It depends on a whole lot of things. Are you itemizing deductions? Because if you're not itemizing deductions, then you're not taking any deduction for state taxes anyway. So you really might want to consider those PTE taxes. There's not too much of a downside to it because it's really just allowing you a deduction you wouldn't otherwise have. However, it is an additional filing sometimes, so there can be reasons not to do it. The other thing just to mention is there are a few states that have PTE regimes in place and they expire automatically because 12/31/25 was when the federal SALT cap was going to expire until this new legislation passed. So now there's states that actually still do have their PTE things set to expire, which I doubt they will. I'm guessing these states will act to keep it going because there's really not much of a downside for states either because they're more likely to collect their revenue by doing a PTE tax because they're getting it directly from the entity rather than relying on the individual to fulfill their filing requirement. So I'd imagine they will pass those, but just something to keep in mind. That brings us to polling question number 2. So if you've zoned out, pay attention. You need to answer the next polling question. Which provision of the One Big Beautiful Bill are you most interested in? 100% bonus, personal credits and deductions, the SALT cap increase, or the change to interest expense limitation? Make sure you get your answers in now. All right, a couple more seconds, get your answers in. All right, can we see what everybody put? All right, it looks like mostly we're interested in those personal credits and deductions, with 100% bonus being our second answer. Fantastic. All right, so that brings us to our second category here, which is about Nexus and the best practices when it comes to Nexus. So I always like to touch on this in my webinars because it's something that should be monitored consistently. It's something that's very easy to forget and not pay attention to. So here's your reminder. If you haven't looked at your business's Nexus in a while, make sure you do so. So to give a little background, what is Nexus? It is the minimum connection that a business must have with a state for the state to be allowed to impose a tax requirement, either a filing requirement or be allowed to collect taxes from the individual. So just to give a silly example, if Utah sent me a notice all of a sudden, I've never, set foot in Utah, I'm not doing any business there, they sent me a notice that I need to file an income tax return there, that would make no sense. I don't have anything to do with Utah. So Nexus is essentially, okay, what's the minimum contact you need for a state to actually require you to file? It does vary based on tax type. So there's income tax, excise tax, sales tax, and even Nexus for business registration. What's the minimum contact you need with the state to be required to register there? So it applies in all different ways. And there are some exceptions to it as well. So for income tax, for example, we have Public Law 86272. I'll explain that a little bit more in the next slides, but it only applies to income tax. So it's kind of a unique, there's a lot of different unique rules when it comes to Nexus. As far as types of Nexus, the kind of initial one was physical Nexus. So are you physically in that state? And that can mean a couple different things. It can mean you have inventory stored in the state. It doesn't even have to be your own building, but you have inventory physically located there. It can also be you have an employee working from home in the state. That can be physical Nexus. And that's one that has become more and more popular in recent years, of course, with people working from home. And then the business often doesn't realize that that creates Nexus for them. And then even if you have other, parties on your behalf physically traveling into the state, that can potentially cause Nexus. But again, it depends on the situation. It's very, very dependent on, what exactly is going on. So there is a Senate bill in place called the Mobile Workforce State Income Tax Simplification Act of 2025. It would set a uniform 30-day threshold before employees who travel across state borders for work become subject to personal income tax, and employers have withholding requirements for those employees. So basically it says if an employee is in a non-resident state for less than 30 days, that state can't require them to file in that state. So it's really just to simplify things because, theoretically, if you travel across the country for work, you could have to file in every single state, and that would just be kind of obnoxious. A lot of states wouldn't require that, but again, it depends on the state rules. So this is a federal Senate bill that's limiting that and making it simpler. So kind of similar to Public Law 86272 once we talk about that. I think it would be a good thing. It would definitely simplify things, but I have no idea at this point whether it's likely to pass or not. So we'll just have to keep an eye on that one. So in addition to physical Nexus, then you can also have economic Nexus. And again, we'll talk about this in a minute with Wayfair and how economic Nexus came about. But economic Nexus is if you have a certain number of sales into a state. So if you're utilizing that state's customer base by selling things to customers in that state, that is economic Nexus. So you're economically benefiting from the state. So they're saying that gives us the right to impose tax on you because you're benefiting economically. So kind of a different concept than physical. There's also other different types of Nexus. You can have digital Nexus, and we'll talk about that with the technology section, but it does get very complicated. The economic Nexus, again, we'll talk about that more. There's a lot of removal of, a lot of states have $100,000 of sales or 200 transactions, and a lot of states are getting rid of that 200 transaction threshold because it just doesn't make sense. If you only have 200 transactions, they might be very small transactions. It might still not make sense to require businesses to file with that. So I definitely recommend reviewing your Nexus. Normally what I recommend is start with that economic Nexus, mainly because it's the easiest to quantify. What are your sales by state? If you can list out your sales, how much in sales you have for the year in every state, take a look at that and say, okay, where's my biggest risk here? You know, you start with the biggest amount and we work our way down and we see where's their risk. Business owners often have to decide how much risk that they're comfortable with. That's just something you can work with a tax professional on. I do that all the time with clients because it helps when I can get to know my clients and what they're doing. And then with my knowledge on Nexus, I can make a determination of whether or not they're required to do a filing or to do anything in that state. So just review those sales, start with that, and then really just think about, where are you physically traveling? Are you going to trade shows? Do you have employees that work from home? These are kind of the things to think about and the best practices when it comes to Nexus. So I did skip over that voluntary disclosure program. I probably should have had those switched, because if you do realize that maybe you have Nexus in a state that you have not been filing in, that's where voluntary disclosure programs come into play. A lot of states have these, and it is a program that basically says you're allowed to come forward as a business and tell the state, hey, I haven't been filing and I realized I should. It wasn't intentional, but I'm coming forward to report my liability. They come forward voluntarily, and then the state appreciates that and often will remove penalties on prior filing, so you won't have to pay any penalties then. And then, in my opinion, the bigger benefit is it often limits the look back period. So if you come forward voluntarily, you might realize that you've been in a state for a pretty long time and didn't realize you had to file. That happens all the time. The voluntary disclosure programs allow that to be limited to the last 3 years. So you can kind of only have to look back for 3 years, and you can kind of then take a breath of relief for the years before that, because the state, once you enter into that program, they can't look back at those past years, or they're typically agreeing not to look back at those past years. Without that voluntary disclosure program, they would be allowed to technically look back as far as they want, because there was no filing, so nothing started the statute of limitations. So they're highly recommended, highly beneficiary if you do realize you have an outstanding liability. All right. Let me just see, I have a few questions here. I want to see, let me go back a little bit. I apologize, I just saw that I have a couple of questions and I want to address these. So I have, would Senate Bill 1443 apply to New York City, or would New York City just ignore it? And I believe the Senate bill is that the mobile, yeah, okay, that's the Mobile Workforce State Income Tax Act. That's a good question. Would the state just ignore it? Possibly, but that could lead to lawsuits. So I think that's the point of the bill. It's kind of like Public Law 86272, and I'll get to that, but like states could choose to ignore it, but then they might get lawsuits as a result. I think that would be a difficult one, especially with somewhere like New York City that probably does have a lot of people traveling in and out. But the key there probably is the 30 days. I would hope that they would follow it. I can't say for sure, but that would be something that we'll just have to wait and see, and perhaps somebody would have to sue them on it in order for them to take it seriously. All right. Going into a brief history. So just I keep saying I'm going to go back to PL 86272, and now I will. So Public Law 86272 is a federal rule that says if your only contact with a state is taking orders by, say, mail or telephone, and you may have a salesperson there, but they're only there to solicit sales, they're sending orders back to the home state for fulfillment, and then this home state is shipping those sales in. If that's your only activity, and this is just tangible property, so you're shipping an actual item into the state. If that's your only activity, then the state cannot impose income tax on you. So it's a federal, it's kind of similar to that other Senate bill with the mobile workforce one, but this is one that actually is in place and has been for a long time that says the state cannot impose an income tax. They can't charge you an income tax if your activity is limited to those protected under PL 86272. There's a lot more detail than that, but generally it's if all you're doing is soliciting sales and you don't have any other activity in the state, then they cannot impose income tax. That is only income tax. So it doesn't apply to sales tax, it doesn't apply to excise tax, it doesn't apply to any other type of tax, it's just income tax. But I do have clients that file under PL 86272, but it is very limited, so you have to be very careful, and we'll go through that with this history. So that passed in 1959, around when mail order and telephone commerce was becoming more popular. Fast forward to 1992, then we had a case of Quilcorp v. North Dakota, which essentially just reaffirmed physical presence. It reaffirmed that you need to be physically in a state. Physical presence at that time was really the only type of nexus. So it affirmed that you had to be in a state in order for them to impose nexus on you. Then fast forward again to the 2010s, and states are getting a little frustrated. They're getting frustrated because there's a lot of internet sales and things like that happening that they have no way to tax because the companies aren't physically in the state. So states begin to adopt new nexus standards such as click-through nexus and affiliate nexus, anything that they can do to try to pull in that revenue that they're missing out on. So they're putting all these rules in place. And then finally in 2018, which probably was the point of putting all these rules in place, was so that eventually somebody would challenge them and it would go to the Supreme Court, because they're really trying to get these physical presence repealed because they're missing out on a lot of revenue. So in 2018, we have South Dakota v. Wayfair, and Wayfair, if you're not familiar, is an online company, sells a bunch of furniture typically, and they ship it. Wayfair, they were sued because South Dakota had a rule in place that you had to file and collect sales tax if you had over $100,000 in sales or 200 transactions into a state. And so they sued Wayfair because Wayfair refused to comply with that. And then it was actually South Dakota that won. So that overturned the Quill argument that you had to have a physical presence. And so all of a sudden now all the states kind of have the okay to go forward with economic nexus. And that was really the beginning of all the economic nexus changes. So all states with a sales tax now have some sort of economic nexus. That really put it all into place, and every single one that has a sales tax has some sort of economic nexus rule for sales tax at least. Recently, the MTC, going back to income tax, they issued revised guidance on Public Law 86272, and the MTC is the Multi-State Tax Commission, and they represent a lot of states. So they're on the side of the states, not the businesses. And the MTC issued this guidance giving their opinion on what PL 86272 actually protects. And it was a very, very limited opinion. So they really narrowed the scope of what is protected under PL 86272. And then following that, states like California and New York adopted rules that treated these certain online activities that were addressed by the MTC, like live chat online, post-sale support. So they basically said any of these, like use of cookies in the state, is in-state business activity that's not protected under PL 86272. So that just makes it really hard and a little bit risky, actually a lot risky for businesses to claim PL 86272, because they really need to make sure they don't have any of this activity that the state is not going to allow. There have been challenges to California and New York's rules that came out, but there's nothing really super definitive on that so far. So if you're claiming PL 86272 and saying, hey, our activities aren't enough to require us to file an income tax return or to pay income tax, you just have to be careful because any of this kind of stuff, they could challenge it. It's always a risk. All right, and we will move on to technology and taxes. So just to give a little bit of background, with sales tax in particular, states are getting more and more aggressive on what types of technology are taxable. So software has been taxable for quite some time now, but generally it's only taxable if it's custom. Not to say there aren't any states, or I'm sorry, it's only taxable if it's canned software, meaning it's like pre-written, like buying Excel or something like that. Something that's not custom to you is generally taxable. Custom software is typically not taxable in most states, but then it can depend on the method of delivery. Some states, again, it matters. Some states it doesn't. Is it a physical CD that you're delivering, or is it electronically downloaded? That can make a difference. And then there could be business use exceptions as well. Really, my point here is just that there's a lot of different rules surrounding technology and software and how it is taxed. And you have to be really careful what you're being charged by vendors, because they might default to just taxing something that isn't actually taxable. But you really have to kind of get an understanding of those rules in your particular state. So the other thing is it gets confusing because with software related services, is it software? Is it a service? There's a lot of gray area of what it actually is, because there's software as a service, like things like research software where I'm going into a database and searching something. It kind of feels like a service because I'm asking a question and getting an answer, but is that really just because I'm accessing software? That would be something that's kind of considered software as a service. So again, it's getting more and more aggressive. Pennsylvania is pretty aggressive with it as well. That brings us to my next slide. This one I think is a little bit, it seems a little bit, I don't like how the taxable and exempt column look the same size, because Pennsylvania taxes most things, or as much as they can. It really only looks the same, like the same size list, because I've got a lot of like parentheses there clarifying things in the exempt column. But for the most part, Pennsylvania, if anybody asks me a question on taxability of software in Pennsylvania, my immediate response is going to lean towards taxable. Not to say there aren't any things that are exempt, but generally the exempt things in Pennsylvania are the things that are really strictly services. Like, I'm just consulting on the computer software. I'm just doing training. I'm not including any actual software with it. So any questions on that, please reach out. I'm happy to answer any questions you have on this type of thing. But then looking forward, I wanted to talk a little bit about AI, because obviously it's a pretty hot topic right now. So how does that impact taxes and tax compliance? So first of all, tax compliance, there's a survey that says, there's a statistic there that 84% of tax and accounting professionals see AI as a force for good. So that's really optimistic. That's from the Future of Professionals report by Thomson Reuters. It was a survey of over 2,200 professionals and executives from over 50 countries. So pretty big survey. And it seems like most in general are optimistic about it, because it can be good for automating the repetitive so that you can focus on the more important things. I think most tax accountants today will tell you they have enough to do and would be happy to have a few things taken off their plate and automated. So, you know, I'm sure there's always the risk of losing jobs, but that's something that it sounds like by and large accounting professionals see it as a good thing. The other thing I wanted to mention is the use of AI by taxing authorities. So the IRS started using AI in 2024 and uses it both to improve tax enforcement and taxpayer services. They use it for enforcement. They do things like identifying high-risk returns, identifying patterns of fraudulent activity. It could even potentially start to identify errors before a return is filed. So possibly if you go to file electronically, you might get a little pop-up that says, are you sure that this part is right? Because AI might be able to identify that something looks wrong. So you can see the potential there. It could be good or bad. I have the good, the bad, and the ugly there, because it depends on how it is done. Is it with automated notices going out? That can be a good or a bad thing. If they're accurate, it's good. Sometimes though, when automated notices go out, we see a lot of errors and that type of thing. So it just depends how it's done. The IRS is also using AI they may use it to process paper returns. So the AI can generally extract data from forms and read returns and kind of transfer them to electronic format, really speeding up the process of paper returns. And then they're also using chatbots for customer service and things like that. So all different types of ways that this can be incorporated. So with all those benefits comes a lot of different things like tax implications. Could the use of AI impact nexus? If there's, you know, a server somewhere that's using AI in a state, could that be considered kind of like an employee working from home? Could that create nexus in different states? Is that a possibility? If an AI bot is doing trades in the stock market, would that revenue be sourced wherever that AI bot, like, is there something there? Like, there's so much to think about when it comes to this kind of thing, and I find it very interesting, and we'll just have to kind of wait and see what implications we have going on. And then, of course, I can't ignore the pitfalls. There's certainly pitfalls of AI. I will say, like, I use AI fairly frequently for tax research, for example. We can use AI, but of course, you have to be very careful, because you have to check your sources and, you know, fact check and make sure everything is actually accurate. AI has been known to make up court cases. You know, you have to be careful of what type of AI you're using. I try not to use ChatGPT for my tax research. I use a more reputable one. So you have to be a little bit careful of what source you're using and make sure you're fact checking on that stuff. And then of course there's privacy issues. I certainly would not put any client data into an AI bot. And then the other thing just to mention is algorithmic bias. So problem with anything that uses compiled data is that data can be biased. So if I use AI for, say, hiring, for filtering through resumes, for example, if that AI is based on data that suggests that white men in their 30s tend to do well at the job, that can be kind of an issue, because then it's filtering, you know, out a certain way. So you have to be very careful of any type of algorithmic bias when it comes to AI. I just thought this was interesting. I'm going to skip over it. Just different types of AI. It just kind of got me thinking about how, you know, different types could potentially be taxed differently, have different tax implications. You will get the slides after this, so I'm going to kind of skim over because we're running a little bit short on time here. So that brings us to polling question number 3. Do you use artificial intelligence in your job or business? All the time? Occasionally? No, but I'd like to? Or just no? Make sure you get your polling answer in now. All right, it looks like most occasionally. So we'll see, you know, maybe next year we'll do this poll again and see if it moves to all the time. All right, just to go back really quick, because I realized I did have a question earlier on bonus depreciation, asking if you bought an asset in several payments before 1/19/25 and finalized the purchase and installed and put it into service in April of 25, how much of that investment would qualify for the new bonus depreciation? So that would be based on when the asset was placed in service. So the full amount would be eligible for bonus as long as the asset is placed in service after January 19th. All right, then we're going to move on to Pennsylvania updates. So we don't have a budget yet. We're still waiting. You know, I don't know when it's going to pass. It's pretty late this year. Here, let me see. Do we have a PA budget? Nope. So, not yet passed. Democrats hold the majority of the House. The Republicans control the Senate. So basically, we're just divided, and people can't get along and agree on something. So Governor Shapiro did just give out a couple of comments earlier this week. He noted he's only one of 2 governors in the country with a divided legislature. So we're just waiting at this point to see when it passes. So this isn't that uncommon. You can see there I have a few dates that other budgets were signed into law. They're often late. This is getting pretty late though, and there are some pain points. Like you can see SEPTA there cut routes, and School District of Lancaster had to take out a line of credit to start their school year. So people are feeling the pain on this. So I'm going to skip over these real quick. This just talks about it's a big increase in the budget, and that's an issue a lot of the Republicans have an issue with, is that the budget is a lot more money than last year. It's increased by 7.5%, the spending. And then this is just a breakout of, you know, where that money is going. So this just kind of shows the breakout. So again, the slides will go out at the end. You can take a look at those. But what did the Pennsylvania budget cover? So it's a lot of stuff that Governor Shapiro had in prior proposed budgets, I should say. Increased funding for schools, increased funding for workforce development. There is something to raise the minimum wage to $15 an hour in there. More support for childcare and early educators. Property tax relief, housing portability. They want to expedite the corporate tax cuts. So Pennsylvania previously had one of the highest corporate tax rates. Now that's getting lower, but it's only getting lower by about 0.5% per year. So they want to expedite that. Legalization and regulation of cannabis and skill games, and then a couple of kind of niche things like a PA innovation program for innovation in PA, especially in life sciences, and also a focus on sports tourism, with next year being America's 250th birthday, and also Pennsylvania hosting a lot of big sports events. They want to increase that tourism budget to kind of meet that need. So again, I'm not going to spend too much time, mainly because who knows what's going to be in the final budget. But that brings us to our next polling question. Which of these following provisions would you like to see pass in the Pennsylvania budget? Increased funding for K-12, increased investment in workforce and economic development, legalization and regulation of cannabis and skill games, or raising the state minimum wage. Which would you like to see pass? So make sure you get your polling question in. A few more seconds, get your answers in. All right. So So it looks like more funding, the first two, K-12 and workforce development, are the top two answers. All right, a couple of PA updates. So there was a wage tax case that had been submitted to the Pennsylvania Supreme Court, but they refused to hear the case. So there was a taxpayer that was a Philadelphia resident and worked full-time in Wilmington, Delaware. They filed a refund petition with the Philadelphia DAR for a portion of their city wage tax to be refunded based on requesting a credit for taxes paid. So essentially what happened was their employer was holding 4 different types of tax. Their employer was holding PA, Delaware, Philadelphia, and Wilmington taxes. For the Delaware personal income tax, it completely offset the PA liability, so they were able to take that credit for taxes paid in other states for Delaware on the PA return, and they were able to offset some of their Philadelphia wage tax with the Wilmington EIT. However, they were denied offsetting the Philadelphia wage tax with the Delaware personal income tax. And the Commonwealth Court denied it because they basically said the income's not really subject to double taxation because, you know, you're trying to offset a city tax with a state tax, and that state tax has already offset your state tax, so you can't use the state tax to offset the city. So kind of funny there, but just something to think about as we look at the interaction between different states and cities. There are some weird limitations that sometimes come into place. So that they refused to hear that case, which kind of sets it at denied. So they weren't able to use that additional Delaware income tax to offset their Philadelphia wage tax. Philadelphia also removed their $100,000 exemption for their BIRT tax, which is business income and receipts tax. So they basically, if you have, like, say, a rental, you may not be making net income on it, but if you have receipts that you're receiving rents on, you'll now have to pay tax on that, because if it was under $100,000 before, you didn't have to pay the BIRT tax. Now you would have to, because they removed that exemption. There's a new petition center at the PA Board of Appeals. And finally, the property tax and rent rebate program. This has been in place in a while. It was really expanded, I believe, in 2023. So a lot more Pennsylvanians qualify for that. And it's for seniors or disabled people that have property tax or rent. They can get a credit on that. So that's something you look at the PA website for more information on that. All right, just an interesting chart. This is how Pennsylvania compares to other states. So you can see we're not too high up there when it comes to corporate and individual income tax. But I'm going to move along rather quickly because I don't want to keep you guys too long. Trends in state tax, retail delivery fees, where the state adds a fee to a delivery. So like either potentially Amazon delivery or like food delivery services, states could add a fee to that. We're seeing a couple of states starting to do that. A lot of states have sales tax exemptions for data centers to try to attract those to come to their state. And then taxes on digital advertising. Maryland put one of these in place a couple of years ago, and it's really been challenged, but it's something more and more states are starting to look at. It's imposing sales tax on digital advertising. And then a couple of changes there for Maryland and Washington. I'm going to skip over for the sake of time. Rhode Island has what they're referring to as the Taylor Swift tax now, which, by the way, congratulations, Taylor and Travis. But the Taylor Swift tax is basically a tax on homes worth over $1 million that the person's not using. So it's just to discourage those expensive second homes that aren't even being used, to try to kind of help their housing situation. All right, and then I will let you peruse the graphs. There's nothing too important here. We are out of time, but these are all tax foundation graphs. So you'll get the slides at the end. Feel free to take a look. So let's do that last polling question. Do you wish to receive CPE for attending today's webinar? Please make sure, especially to answer the question if you do, but either way you can answer it. Yes or no, you want to receive CPE. All right, we'll be closing it up here. All right, lots of people want CPE. Fantastic. Hope you answered the polling questions. All right, thank you again for joining us for today's webinar. If you have any further questions regarding today's presentation, please feel free to reach out. Our team would be happy to assist, and my information is right there on the screen. A recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you who requested CPE and answered the polling questions, those certificates will be sent out within the next month. Registration is open for our next webinar on September 11th, Mergers and Acquisitions for Nonprofit Organizations. Guest speaker Franny Riley from McKonly's will join our nonprofit team in the discussion on considerations, typical steps, and common mistakes for mergers and acquisitions. Also, be sure to save your seat for our High Trust team's presentation on the best practices for preparing and successfully completing a High Trust assessment and certification, which will take place on September 25th. Thanks again for joining us and enjoy the rest of your day.